Welcome to This Week in Intelligent Investing, where we examine timely and timeless investing topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Phil Ordway, Elliot Turner, and other thought-leading investors, brought to you by MOI Global. And now, here's your host, John Mihaljevic.
Welcome, everyone, to this episode of This Week in Intelligent Investing. Great to have you with us for episode 2 of season 2, and we have a great discussion ahead. Going to start with Elliot Turner today, and then we'll have Phil Ordway with his segment as well. Elliot, I'll turn it to you. Go ahead.
Great. Thank you very much, John. And, I should point out this week we're recording on Tuesday instead of our typical Thursday, because it's Yom Kippur this Thursday. So, wanted to wish all my fellow observers nice and easy fast and happy and a healthy New Year. Interestingly enough, this week's topic, most weeks it doesn't truly matter which day we're recording because we're speaking about high level, long-term things or more conceptual. And every once in a while we get a topic that I think is like especially timely and relevant. And this week I wanted to talk about labor shortages. And it's something that I mentioned last week in our recording when I spoke about my trip to Lake Placid, where I saw help wanted signs everywhere. A couple restaurants I really liked weren't open on a few days because they can't get workers. And, more specifically, a town like that, where it's very seasonal, they rely heavily on young international workers who use it as a toehold to come to the U.S. for a little bit of time, get a visa to work, and then travel thereafter. And you'd think with COVID, okay, this is normal. It's not normal in the sense that it's not easy to travel across borders right now, not easy to get international workers. So perhaps it's something, confined to a destination area. But just yesterday morning, I got a text, and this text came after having had some weird days with the school bus driver situation ever since the school year started, right? We're in back to school season right now. And, the text basically said, we have a shortage of bus drivers in the school district, and therefore buses will be running late. Now, obviously, that day the bus came 3 minutes early, and a couple of parents were left hanging at the bus stop 5 minutes later when, they missed it. But point being, there's some weird stuff going on out there right now, and school bus drivers wouldn't be an area that you think of labor shortage. But it turns out this is a trend that's taking place across a lot of hourly or lower wage jobs, and it's something that's been an acute problem in the economy as things stand. So I spent much of my formative years in investing worrying about labor markets having too much slack. And, I've often attributed the disinflationary period to having very loose labor markets where it's pretty easy to hire people for just about any job. And thinking that until there's an inflection in labor supply getting a bit tighter, that we don't really have to worry about inflation at all. And we had an episode last season where we talked about some of these supply chain shortages. And, I was quite emphatic that these forces are transitory. But, on the one hand, I want to ask the same question with respect to labor markets. On the other, I'm thinking some things are quite a bit different. So a little more than a year ago, we had the highest unemployment rate since the Great Depression. Obviously, that was catalyzed by the lockdowns following COVID and changing our lifestyles to accommodate this pandemic. But now we're experiencing some of the tightest conditions, and, the Fed's still at zero on interest rates. And I'd really been thinking the inflection had happened as 2018 was turning to 2019. So I actually wrote about it in my year-end 2018 letters. And I was having some conversations with several CFOs at the time in manufacturing and in logistics. And they were saying things like labor tightness was starting to be a challenge. I had one CFO tell me that it was, in fact, an even bigger challenge than supply chain issues from China at the time. Again, this is back, 2018 giving way to 2019. But we never truly got to see that play out because, the Fed kind of made the policy mishap of that mistimely extra hike in December 2018, had to reverse course. And, there was just a lot of other drama before COVID hit. And we never truly got to test whether there's something catalytic and enduring in the change there. In part, this was the Fed's policy goal. I think Powell had been more explicit than Yellen, who had been more explicit than Bernanke. They would let things run hot for a little while after having had a period of running below trend for growth for quite extended period of time. So the way I see it, there are two big ways to ease labor tightness. You could have rising wages, which makes labor more expensive. And so some employers will, hire fewer people. You could also have, and demand will drop accordingly in certain areas as prices go up. And you could also have more capital investment, because a lot of questions are considerations of, should I hire an incremental worker, or should I invest in technological capacity to do something a little differently? So rising wages do cause problems for some kinds of companies, but they do also offer opportunities for others. And this is true with both capital investment and rising wages. And both are in some ways very supportive of GDP growth. But the question is whether it's nominal or real, right? In some cases, you can make the argument for either, depending on how it manifests. There's also the separate question of what may be great for GDP growth could actually be quite terrible for the stock market itself. Very high periods of GDP growth tend to actually correspond to not such great periods in the stock market. I was hoping to think through some of the investment ramifications. I wanted to point you all to a great crowdsourced Twitter thread by Compound 248 the other day. He specifically asked, what is the best way to get long wage inflation? I gave a not so serious answer at first, but then I gave my real answer, which was part of what I wrote about in the 2018 year-end letter. This company, Cognex does machine vision. And very specifically, Cognex is replacing humans in manufacturing, in logistics, in areas where, it's either people looking for defects or people scanning and recognizing barcodes. And the math's very simple, right? For a company in that case, they're looking, is it more NPV positive to hire one more worker or to invest in my automated capabilities? And so I think it's, a fascinating idea, very timely. They've often said the biggest impediment to faster growth in machine vision, right, in technology has been this ease with which employers could hire people. But now you see Amazon raising their prices for their warehouse logistics facilities. There's something very different right now. And then one of the other areas that I didn't answer that specific question with was, I think payment companies are really interesting. You look at a company like PayPal, and the generality behind this is you look for companies who have very high fixed costs, who have revenues that are positively exposed to rising wages, right? If labor gets more expensive and people are spending more money in places, and yet PayPal doesn't have to spend more in its own right, that's quite interesting. So, I was thinking those are two specific areas. And then what I wanted to do is, open it up to you guys, Phil and John, hear some of your perspectives, both on some interesting investment opportunities, what's happening with the labor tensions, and whether this is something that's ephemeral or enduring, why it's happening. One thing I've heard a lot of people say is unemployment benefits were too lax for too long, though. I think there's that's not exactly in place anymore, and yet it's still problematic. But I'd love to hear more on what you guys think is causing this. And then, John, I wanted to hear, is this something that's uniquely American? And I'm seeing this from the perspective of someone sitting here in Connecticut, or, how's the situation in Europe? Is it similar? And then in general, is it structural or frictional? Are some of these changes because people have to get new kinds of jobs with how we're adapting to COVID? Or is, what I was seeing in 2018 to 2019 something that's like truly manifesting now? So let's open it up.
Oh, there's a lot there. I don't know quite where to start, but one observation that jumps out a lot when I dig into this is I just pulled up the data on the Bureau of Labor Statistics website, and it's pretty stunning if you look at the labor participation rate over the last 20 years. So going back to August of 2001 through August of this year, it's basically been a one-way train straight down. Right? I mean, so August of 2001, the labor participation rate was about almost 67%. Right now, it's a little under 62%. And that's millions and millions of jobs, right, that are not being filled by people that are currently in the what's called the civilian workforce, right? So not in school, not in the military, not of retirement age or school age. And, so it was down but steady-ish until the financial crisis hit. The financial crisis took, 2 or 3 points out, and then we just continued to kind of bleed off participation rate points, going from 66 to 65 to 64. It kind of leveled out in the 63 and a half range until the pandemic hit. And then here we are. And so I just wonder, I guess the first thing I'd throw back is that any big issue like this has to be multifactional, right? There has to be some confluence of things going on here to create something like this. So I don't think there is one answer. And if there is one, I certainly don't know what the one variable I'd isolate would be. But two, if something like that's been going on for 20 years and you look at some of the obvious demographic changes in the country and in the world, I think that's a smart place to start looking. And so I just have to wonder if this is a structural long-term issue that we're going to continue to face, I think with good reason. And if that's the case, then we may never recover the pre-pandemic participation rates. And, anecdotally, I think if you look at it, it's pretty stunning when you consider that last year, somewhere between 4 and 5 million Americans voluntarily stopped working, and what that means for the economy going forward. Some of those decisions were because they were in very low wage jobs that were not fulfilling and don't really make any economic sense, both in the fact that, it's hard work and there's other ways to make ends meet, whether it was through transfer payments or, insurance of various forms through the pandemic, or whether it was because the costs and benefits just don't shake out. I mean, particularly in light of healthcare. I mean, at the other end of the spectrum, it's not just a debate about minimum wage. I personally know a handful of medical doctors that quit their practice last year during the pandemic because there was so much chaos in the world, and with kids at home and not in school, what do you do? So it takes a long time to recoup those gains. I mean, another way to look at this is particularly through the lens of the pandemic. There are now about as many women participating in the labor force as there were in the early 1980s. And I just don't know how long it might take to recoup those levels. So my strong opinion, without any way of proving it, would be that this is a long-term structural issue that we'll still be facing and dealing with years from now. What do you think, John?
Well, I have to admit, it's a little bit over my head to try to predict anything here. I can just make some observations, but I feel like anyone who pretends to know, including the Fed chairman, is either straight up lying or is delusional. And I would expect more from the Fed than, pretending to know everything and have a complete handle on everything. But I feel like that also tells us something, because when you're dealing with institutions that fear potential consequences of saying that they don't know, or trying to be a bit more differentiated in how they're analyzing a situation, that tells you that we are at a potential turning point, and maybe a bit of a dangerous point in time in terms of the economy and what might happen. Because we're not just seeing labor shortages. I mean, we've seen issues in all kinds of markets and segments of the economy. And certainly some of those are transitory, but I don't think the inflationary pressures overall are transitory. And when you look at the way that all markets have rallied, basically, including some very clear bubbles, in my view, in some markets, like things like NFTs and other areas where, again, I don't know whether these things are for real, but I know that they're only possible in this kind of market environment. And, or take housing prices in the US. I mean, should that be considered inflation or not? Clearly, it's an asset class, but it's also something people want to have, and it's becoming much more difficult to achieve that. And there can also be spillovers from asset markets to the real economy. I mean, if you think about just kind of a way of thinking that I like is kind of a take things to the extreme. You know, if stocks keep going up at this pace and the market's worth 200 trillion, people can sell those securities and use that money to buy things in the real world, and that would lead to all kinds of price pressures. So I do think the environment is something that investors should keep in mind. I don't think it's an environment in which 0% or in Europe, it's actually 0% on the 30-year government bond denominated in euros. And that is just incredible. And I don't think any sane investor would lock up their money for 30 years to just get the absolute same amount of money back in nominal terms. So clearly there are things going on that are not reflecting a free market. And I think shortages in labor, just to get back to the topic, we are having shortages in labor in a free market that should lead to higher wages. And that's how you get rid of the shortages. Now, I know from having grown up or spent a few years growing up in a communist country, in those countries, shortages can persist because the government will say the price of bread cannot go over this amount or what have you. But then what ends up happening, you have no more bread for sale. And, we're now seeing that restaurants in some parts of the US are having a really hard time hiring workers. So that's a little bit from me.
Yeah, one interesting implication of that, and by the way, in case it wasn't clear, I don't have any great predictions either. I'm just pointing out the long-term nature of this and the way it's persisted through some pretty tumultuous times over the last 20 years and what that might mean. But to your point, John, which I think is really interesting, what if one takeaway from this is that at the high end, if you have lower than you'd expect labor participation at the high end, it could be just because, at least in the US, probably in parts of Europe as well, you have a fairly wealthy aging demographic, right? That would lend itself to lower participation rates, right? I think we can agree on that. And if that's the case, then it doesn't really reflect the lack of a free market. It just kind of reflects the demographic circumstances we're in. And at the low end, you're talking about, unfilled jobs at an hourly rate that are, somewhere around the minimum wage type level. What if there is actually a free market at work, implicitly at least saying that, all right, these jobs aren't enough to sustain, a lot of economic prosperity for the labor supplier, right? The individual employee. So the obvious implication of that is just that those jobs are going to be completely and totally replaced by technology, right? Everything from the person working at McDonald's, on down the line. We can come up with, just about every job in that universe, not every job, but a good chunk of them can be replaced by technology, right? And I mean, just as we domesticated animals and to start plowing the fields, and then tractors replace horses, computers and technology can replace cashiers, and on we go, right? And as computers and technology replace those low-end jobs, isn't that going to be deflationary as it's always been in the past?
Yeah.
So yeah, just go ahead. Go ahead, John. Sorry.
No, I was just going to kind of reply to Phil there. I totally agree. I think that will happen, and that does kind of push things in the other direction. And I think we're also just kind of seeing a little bit the kind of society we'd have maybe with, when you hand out money to everyone with, then you basically get the low end labor saying, hey, I don't need to work for such a low amount. So we're seeing a little bit of that as well. Elliot, sorry, go ahead.
No worries. Yeah, no, you guys made a lot of good points, and there's a lot to chime in on. I think that effect of technology replacing labor, it's as old as it's older than the Industrial Revolution. But one of my favorite examples was of, I think it was Perrier, their original invention. They weren't per se a bottled water company at the time. What they did was formerly people would carry water bottles up flights to have drinkable water on higher floors in the city of Paris. And they created a water elevator to make sure water could get up there without people. And there was like a mini revolt about it. But Technology has been replacing jobs, freeing people to do other kinds of jobs that formerly were not ones that you'd consider, commoditized kinds of labor. So I just think that's a cycle that keeps going and will be as old as time. The other, I think you both made a really good point about this high end in the labor market. And, I wrote up these 10 things that will change with COVID in my Q1 2020 letter. And number 10 was leaders stepping aside, of how, predicting this accelerating passing of the torch from boomers to millennial generation in corporations around the world. And then very recently, I've started seeing these phrasings and headlines about what they're calling the Great Resignation, and about how it's actually quantifiable now, the extent to which Americans 62 and older are retiring now. So we went through a period, I'd say probably from the 70s through the 2010s, of people working longer, of the retirement age rising. And suddenly, for the first time in, call it half a century, the exact opposite is starting to take effect. And it's like a very interesting force. It creates a lot of dynamism in the economy, I think, having younger people take the helms of companies, giving younger people some sort of upward mobility, which had been formerly absent for a long time. There was this like ceiling and layers of older people who just kept staying longer and longer. And, it's hard to think about how that manifests on the lower reaches of the labor force, especially as, one thing that I didn't say in my prepared part, but that I was thinking about, heading into COVID, you actually had tighter immigration in the US, which had been a meaningful force offsetting some of the kind of changes in the domestic population and how that was progressing, specifically, younger people willing to work some of these more menial, lower paid jobs. So without that whole labor pool, things changed a lot too. So those are two big forces that I've been thinking about. And it's hard to kind of wrap your head around what it all means, though.
It is. It's almost impossible. And so that's where I was actually going to make one caveat, was that in terms of a big idea, you mentioned this Twitter thread about how to get long labor shortages. I can invest behind for a decade. I'm not sure getting, quote, long labor shortages is the kind of big idea that really works, at least for me, just because I think it's so easy to misinterpret or get wrong.
Just to be clear, it wasn't about labor shortages. It was about rising wages. So how do you get long rising wages?
Okay. All right. Fair enough. Almost the same thing, but that is a distinction. Fair enough. So, but my point would be the same, which is that I can see lots of ways where wages actually don't increase, at least in real terms, over the next 10 years, right? I mean, like I said, I think the twin forces of demographics and technology are pretty powerful, deflationary or at least disinflationary from here. So I think that's kind of tough. I mean, and again, if there is an obvious way to get long, that I think it's the kind of thing that's going to attract a decent amount of short-term attention and probably be priced money. If you really were worried about rising wages, you'd probably be interested in the concept of higher inflation overall, and tips would probably look like quite a bargain, right?
Well,
yeah,
I guess
that's an interesting one.
Jump in there a little bit. My issue with tips, Phil, and I've looked at them for a very long time, is just it's based off of the official CPI. And I feel like that's probably understated now and may get more understated if inflation really starts taking off. But
sure.
But yeah, you would definitely get some protection at least. But I feel like in terms of labor, typically, from what I've seen, is that the low-end labor wage increases do lag inflation. And just given all the dynamics you talked about with automation and so forth, they're probably going to lag inflation by a lot if there is inflation. So there are definitely much better ways to get long inflation than somehow low-end wages. Maybe high-end wages certainly is a possibility.
Yeah. And look, I'm not recommending tips by any stretch of the imagination. I agree. CPI as measured certainly doesn't capture a lot of what matters and what's real. And, if you really wanted to, I mean, you could really stretch and say, all right, I'm going to be long I'm going to own a payroll provider like Paychex or something. my point is it's kind of a stretch and there's a lot of ways to be wrong. Whereas some of the other big ideas that I think fall into this category, it's a little more clear to me to see the path to success. But, one other thing that I just point out is I think if you look at economic history through any part of the developed world, certainly post-industrial revolution, it's that there's been a steady, and I don't mean year over year, I mean decade over decade and generation over generation replacement of labor with leisure, right? I mean, labor participation rates have gone down, hours worked have generally gone down, and particularly as people get wealthier, right? I mean, broadly speaking, across a whole country or a whole economy, I think that's held up. And so what does that mean, right? And as people work less, or as people have fewer opportunities potentially for those entry-level jobs, what does that mean for society? And I don't know. I mean, it's something I kind of worry about, frankly. I don't know if it was true. It's kind of one of those quotes that, it either gets attributed to Winston Churchill, Albert Einstein, or Charlie Munger, and you never really know who actually said it. I think Munger might have actually said it, but somebody at some point I thought made a great point, which was that the best potential business education or business provider of education in the world was McDonald's, because they've had, hundreds of thousands of people had their first job at McDonald's, and they learned how to show up on time, how to, do what was required of the job and what it meant to get a paycheck every 2 weeks. And I think that's a very good point. And so what happens if that goes away, for a whole slug of society? I think that's something we'll have to reckon with. I don't know what the ramifications of that will be.
Well, on that note, Phil, can I ping you for your topic of the week?
Sure. So my topic of the week is actually missing the big ideas, which, like Elliot just said, maybe this is one of the big ideas that I'm missing right now. Maybe the big idea is that we're right on the cusp of having a major and sustainable increase in wages. But what spurred me to this was that while we were on our little August break, it was exactly the 10-year anniversary of Mark Andreessen's famous "Why Software is Eating the World" essay, which ironically was published on a August weekend. The famous Saturday long form Wall Street Journal essay that gets published once a week. Probably at the least read issue of the year, right? The third week of August on a weekend. But I do remember reading it at the time. And I remember, I'm kind of OCD about this kind of stuff. Anything like that I read, I read it physically. If I read it digitally first, I'll print it out and read it physically. I underline it, I take notes on it, and I file it away, and I kind of revisit it. And that's one that's made it into what I call the top folder. And it's, just, maybe a few hundred pages of things that I think really stand the test of time that I revisit from time to time. And it's something that I reread about once a year, if nothing else than to just remind myself of what an idiot I was for not taking it more seriously at the time, because that's exactly the kind of big idea. Again, this is one of these apocryphal quotes, but if you take a big idea and take it seriously, or if you take a big idea and follow it to its logical conclusion, that's really the way, to make big investment gains and to really get, successful in a field. And likewise, it's usually these qualitative insights that have the biggest long-term payoffs, right? I mean, quantitative factors are crucial, right? Nobody likes more data. Nobody likes more number crunching than I do, but that's sort of necessary but insufficient. And the qualitative factors are really where the big money is made. So if you look back at, Andreessen's essay from almost exactly 10 years ago, his concept was funny. At the time, he called them new technology companies like Facebook and Twitter were creating a big stir in the market. Apple was trading at a forward price earnings multiple of 15 times, which is basically right where the market was in the summer of 2011. But at that point, Apple was already the biggest market cap company in America. And from that point, by the way, I looked it up, from August 19th of 2011 through today, Apple's produced a 1,259.6% return. That's 29.6% a year over more than a decade. So it's done pretty well, to say the least. But anyway, his point, he goes on to say, and I quote directly here, there's been too much debate around financial valuation as opposed to the underlying intrinsic value of Silicon Valley's new companies. And I think that's exactly right. Every word of that I would agree with. And I'm completely guilty of this. I would not make a great venture capitalist because I lack both the technical skills and the qualitative imagination to see what can be way out there that seems totally implausible today, but 10 years from now is going to look completely obvious. And you need a handful of those big insights to be 10x, 100x, 1000x home runs in a portfolio of 90% or 99% failures to make it work as a venture capitalist. And I just don't think that's how I'm wired. But what I can absolutely do better is to take something like this, where it's all laid out in front of me in common, plain English, and it makes all the sense in the world, which is that this is a natural evolution. We're in the middle of this cusp right here. He lays out how, the dot-com bust is 10 years in the rearview mirror. And he's saying over the next 10 years, and I quote again, I expect many more industries to be disrupted by new software, often by world-beating Silicon Valley companies. And the companies he mentions throughout the article, again, this is 10 years ago, this is a partial list, but I think I got most of them. Apple, Amazon, eBay, Netflix, Spotify, Pandora, Zynga, Google, Skype, LinkedIn, Square, Salesforce, PayPal. So, everything's laid out for me right here in this article, where I read it, I paid attention to it. I thought to myself, he's almost certainly correct. And yet I sat there twiddling my thumbs, right? Why did I not take more direct action? I did end up owning some of these companies over time, but not nearly enough. I should have had this article, relatively short essay, pinned to my desk, like I have other things pinned to my desk, so that I couldn't go more than a few hours or a few days without thinking about it. And it got me thinking about, it's not just me, right? I mean, as much as I want to beat myself up over this, it's not just me. I mean, I think some of the most obvious big ideas elsewhere are that if you have a business where it has the feedback loop, where reinvestment in lower prices and costs creates more customer demand, which allows you to reinvest in yet lower prices and costs. We've talked about this plenty of times. That's as close to business nirvana as it gets. And it's some of my favorite all-time businesses like Costco, Walmart, Amazon. And yet the greatest investor of all time, Warren Buffett, basically whiffed on all three of those, right? I mean, he certainly whiffed on buying more Walmart when he knew enough to buy a little bit. He basically didn't participate in much of Costco or Amazon. So what caused him to miss it? Because I guarantee you he understands the economics of the situation. I guarantee you he understands the competitive dynamics and the feedback loop that's at work there. So, why do you miss these big ideas, and what can you do about it? And what are the other big ideas that are out there right now that I'm missing or not taking seriously enough? I've got a partial list of my own, but I want to hear from you guys both. What you think the big ideas are right now in the world that should be tacked to my desk, so to speak, and what we can do other than literally like taping them to your forehead. What can we do to, not miss them or not keep making the same mistake over and over again?
Yeah, I think that's one of the hardest things to do, because at the end of the day, I mean, it's part of why I call myself a GARP investor, or self-subscribe to the GARP strategy, thinking I want to make sure I always stay honest to valuation above getting carried away with theme. Because even if an idea is awesome, at the wrong price, it just doesn't make a difference whether you get it right or not. But there are some big ideas that I personally, a lot of my research projects I'll undertake from the perspective of, okay, this is something interesting high level. So let me learn about it. Let me learn about it high level, and let me then start learning about the companies that are involved. And I'll pick like one company as the jockey to learn about a space. So what really got me into Roku in the first place was I was learning about programmatic advertising, spending a lot of time on the trade desk, and kept seeing references to the next frontier being CTV. And I'm like, oh, okay, what are the interesting ways that could manifest itself? But so, that's just some context. So some of the themes that I am paying attention to are specifically, I mean, obviously digitization is a big one. So anything analog, I think, should still have opportunities to go digital. And there are some areas where, there's still much of the underlying business taking place in what I'd call more analog ways than digital. So payments remains a big one, though the narrative there is getting a little too enthusiastic for my tastes. Another one, I wrote about this in my recent letter, but I think curation and personalization are one of the next big frontiers of change. And I am quite confident there are going to be some big breakthroughs in how consumers are able to experience personalized shopping, personalized experiences online. So that's one I've been trying to pay a lot of attention to. And it's not just shopping. It's stuff like, Spotify recommending you specific songs, whatever it may be. Like there's a huge opportunity. I think, alongside those, obviously a lot of these, when we're talking about big trends, it's hard not to escape technology. So I'm not going to keep trying to pound those drums, but I do think, we got to this a little bit in our first section. And Phil, you made reference to leisure being an inevitability when wages are rising. Maybe Keynes was just 100 years late with his leisure and age of leisure and abundance. But I do think, leisure, climbing up Maslow's hierarchy of needs, or, that gets to be something that's increasingly important. There's also in several areas, I think, very powerful premiumization trends. One of the ones that I think is a really interesting sector where that's taken place is in spirits, where, kind of 2 decades into a pretty deep premiumization trend. And I think that's not going to stop anytime soon. I'd be remiss to point out another area being increasingly regulating and legalizing and regulating formerly illegal or illicit things. So cannabis and sports betting being 2 big ones that are taking place across not just the United States, but other countries. And, you start hearing after cannabis is legalized, the attention turns to psilocybin. These things tend to kind of compound on one another. So those are a few. I'll keep trying to wrap my brain for more, but wondering maybe kick it back to you guys for some more.
Yeah, I'll jump in with a few thoughts. Phil, I think you made a great point about a lot of kind of quote unquote intelligent investors focused on the numbers and those kinds of things. And I think that's usually the reason why someone like Warren Buffett person might miss these kinds of companies, because they never look cheap. And maybe you always, if you're a little bit of a stickler on price, you feel like, well, I don't need to buy it now. Maybe it comes in and so forth. I mean, I remember back in the day, a lot of value investors and intelligent investors preferred Sears Holdings over Amazon, because Eddie Lampert was a genius. He was buying back stock. He was rationalizing a whole lot of things, and they had real estate, and there was a good case to be made. But the outcomes of those 2 companies couldn't have been different. So focusing on the qualitative aspects would have served investors really well there. And I think kind of, if you think about the big ideas, I definitely agree that we are entering an age of leisure, kind of that could go very, very a very long way, especially if you think about where kind of the value of labor will be over the long term, as we have automation at the low end. And a lot of labor may be, frankly, worthless. And that's where universal basic income might come in. And if you have a society with universal basic income, that has all kinds of implications, and just greater leisure spending is one of those. For me, another big idea right now is just that, 3 to 5 years from now, we're not going to have 30-year interest rates in the low single digits. I really can't see that. And in Europe, we're not going to have them at 0. So what do you do on there? Who knows? But one thing that, normal people can take advantage of is borrow, take a 30-year mortgage on real estate. And especially if it's income producing real estate, you end up with an asset that grows with inflation, but you're paying a 0% interest rate over 30 years. So that's maybe one idea. Other ideas for me are specific companies that have basically businesses that are unique and irreplaceable. And again, I come back to Twitter. I think if you tell an average person, let's talk about social media. And I don't really like to call Twitter social media, but it's in that category. Twitter would take a lot of mind share. It doesn't take a lot of market cap right now. So just thinking about and also where Twitter is going, they've been really improving on a lot of fronts. And the world, I think the three of us, I don't know about you, Phil, but might actually miss Twitter if it was gone. And we, not sure there would be an adequate replacement. Phil, I see you unmuted yourself, so maybe.
No, I was just chuckling because I agree. I don't know if I'd miss it as much as you guys do. I'd like Twitter, and I think it's very useful in some ways, but I also think it's poison for society in a lot of ways. And I think if it died an instantaneous death, something potentially even better would pop up tomorrow without some of the baggage that comes along with Twitter. That all said, your point stands. I totally understand where you're coming from. So, and I don't disagree entirely, but you're right. I have probably a little glass half empty on that one.
So I'll just throw out another company name so I don't have just one. And this is not an investment recommendation, but just in terms of the qualitative aspect of an asset that cannot be replaced or equaled, the European football club Borussia Dortmund. It is the number two, sometimes number one, usually number two after Bayern Munich. Football club in Germany, the largest economy in the EU, and it has a rabid fan base. Those are not customers; those are true fans. They love the club. Their grandparents, parents, and their kids love the club, and that's an asset that, with inflation, without reinvestment in any capex or anything, is going to have tremendous value over time. And right now, that asset is available for about 500 million, including the ownership of their stadium, which is the largest stadium in Germany and maybe one of the largest in Europe as well. So you're really not paying much for what is a really unique asset. And, but you could say, well, football clubs never earn money, and the numbers don't really make it that compelling, I have to admit. So it's a stretch, and it may not be a good investment. But just in terms of the potential, I feel like that is one where you're really kind of the qualitative aspect is very different from the quantitative as it is today.
It's funny because I just pulled that up on the same time horizon for Apple that I did with the Mark Andreessen article, where he called out Apple as being the largest market cap company in the world in August of 2011. And again, one of my thoughts at the time was like, yeah, sure, it's at 15 times earnings, but it's the largest market cap company in America. How could I possibly have any insight here? How could this possibly compound at a good number from here? It's already the biggest company in America. And then it went on to compound at 30% a year for the next decade. So that was dead wrong, to say the least. And yeah, Borussia Dortmund's actually compounded it a little bit better than the German market, a little over 11% for the last decade. And I tend to agree. That's another one where I would have been dead wrong. I mean, at various points in time, everyone from Mark Lazary and Wes Edens buying the Milwaukee Bucks and turning that into the biggest home run you could imagine, or the group that bought the Golden State Warriors, or even the Clippers, right? The LA Clippers has worked out, I think, pretty well, all things notwithstanding. And the financial, the numbers on the page don't speak to the value, and so I think you have to be careful there, right? Because it's not speculation per se, where you're relying on a higher price from someone else to bail you out, but the value of it is in the generation over generation ability to provide something lasting and durable. And if there's one thing, when people ask me, like, what's a big change you've made in the last 10 years in your own investment style, it's that 10 years ago, I was probably still a little bit too much in love with buying something at 50 cents or 70 cents on the dollar for what it was worth today, and completely underappreciating the power of duration. And I mean duration both in the bond math sense of it and in the qualitative sense. We did a whole episode on this last season about duration and equity investing. And when you find something with true duration on its side, like Borussia Dortmund and probably like Twitter, I I don't think Twitter is going to go away anytime soon. That's for sure. I would fully expect both Twitter and Borussia Dortmund to still be a part of the conversation 10 years from now. And I think that's enormously valuable. So those are excellent ideas, excellent examples. For my 2 cents, the things I wrote down were, I also called out kind of, as I mentioned in Elliot's talk about the increasing amount of time and resources devoted toward leisure. I think that is a good one. We just touched on that through those 2 ideas. I think that's an obvious example. I still think some of the big ideas that I've missed over the last 10 years very much still apply. And just because I feel like I missed them recently doesn't mean that I should continue to miss them. And I'm continuing to make the same mistake today. So businesses that reinvest to lower prices and costs and pass along that savings to the consumer, hugely powerful. Software is still eating the world, right? So even that essay that's now a decade old, I think still applies very much so today. I don't think that's going to change. And just more broadly, the Amazon ethos of what won't change, right? So look for businesses where, again, I don't think value investing is a statistical analytical framework of reversion to the mean where you were buying something below net working capital. That hasn't worked for a long, long time. But what I think value investing does retain is a bet on reversion to the mean in the sense of what is truly permanent and lasting versus what's ephemeral or psychologically driven in the short run. And so things that won't change, right? I mean, consumers are always going to want more selection, lower prices, faster shipping, right? All the stuff that Amazon calls out. And I think they're entirely correct. Like, you can invest behind that for years on end with confidence, even if it looks ugly in the short run, because those things are truly persistent. Likewise, I'll never not be in love with low-cost business models, right? And there were things like, we've already talked about Costco and Walmart and those types of businesses, but ultra low-cost carriers in the airline world that just, beat people to death for 20 and 30 years because their business models just made so much more sense. I think that will certainly continue. And I actually flipped it around. I mean, what are some things that are big ideas that have led people astray? And so this is another good area to think about, right? I mean, maybe you have an anti-bulletin board where these are things you just don't want to get caught up in. I mean, most prominently, right as I was starting my career, I heard over and over and over again, don't worry about correlation because housing prices have never fallen nationally, right? I mean, that was a truly big idea that led to a generational disaster, and you have to avoid that kind of stuff. I know I could probably get John going on MMT, right? And endless fiscal deficits and dropping money out of the sky. I mean, again, I think that's popular in some circles right now. And to say the least, I think the jury's still out. I do think today there's big ideas around the concept that, just as I completely agree 100% with Andreessen's notion that you can't be prisoner to numbers on a screen or on a page and get tied up on the financials and the valuation in a DCF concept and miss the true intrinsic value. And similar to what you mentioned with Borussia Dortmund, I totally agree with that notion 100%. But I also think it gets taken way too far when you see lots and lots of companies trading at 10, 20, 30, 40, 50 times sales, right? I mean, that, you can't be prisoner to financial valuation, but you also can't ignore mathematical reality. Some of those companies will work out. I think the vast majority will not as an investment. So that's one thing. That's a big idea I have in mind right now, or just overconfidence about anything in general. I mean, a big idea that I always carry around is that overconfidence is the most deadly sin in investing, and try to avoid that. So those are the things I came up with, and I'm going to go back and repin this all to my desk and maybe dig in on some of this some more and try not to avoid the mistakes try not to repeat the mistakes of the last decade, because there's a lot of good ones here.
Maybe just one big idea that came to mind as we were talking, to me, is fintech and the implications it's going to have on banks. At the end of the day, I view most of finance as commodity businesses. They're in the business of selling money, basically, or some derivatives of that. So if you take that view, then a bank is like a store that sells a digital good, money. And stores that sell physical goods have been disrupted. So why wouldn't these kinds of stores that sell money be disrupted? And I think they will be by fintech. So, that's maybe a big idea that you could think about if you want to own banks or own banks, and kind of how that's going to look, not over the next year or two, because I think in the short term, the interest rate cycle is going to have a bigger impact. But if you take a view of a decade or two, then this could be, game changing.
Yeah, that's a great point. I tend to agree with you for the most part about legacy banks. I think it's tougher now than it's been for them in a long, long time. And I don't think legacy banks will necessarily all have an obituary next to their name 10 years from now. I think there's a lot of banks. JP Morgan comes to mind as a very forward-thinking bank with a dominant entrenched position. I win a lot of bar bets with people. I put this on a good reading email of mine probably 3 or 4 years ago, that JP Morgan has more software engineers than Facebook has employees. And so I think that bodes well for JP Morgan's ability to invest enough to stay ahead of the digital curve. But I agree with you, John, that, fintech can get ridiculous and get taken way too far. But the big idea behind it is very much valid. One other one that's kind of related to that I wrote down that I forgot to mention was, for a long, long time, you could really do well investing behind consumer brands. And that's been true for, forever, basically, I would say. And I think largely because of technology and the big idea that software is making price discovery and information ubiquitous, I think the value of any sort of consumer brand, at least in the traditional sense of it, has probably never been lower. Right? I mean, it's never been easier to attack an incumbent consumer brand. And so that's a big idea that it's harder to exploit. It's easier to play defense against this by saying, I'm not going to quote unquote buy the dip on a legacy consumer brand. This came up actually in the context of some of the big soft drink companies and some of the big brewing companies. A friend of mine mentioned Boston Brewing the other day, which is having a rough year. And it still just looks kind of vulnerable, in my opinion. Not that I know what's going to happen, but I can see lots of ways where it's going to end poorly and only a few ways where it's really going to end really well. And that's tough, right? And I can see the opposite for lots of the big ideas we were talking about on the flip side. So those are the kind of things I just want to avoid.
I want to chime in a couple things. I'll give a quick Boston Brewing note, which is I think their skill has been staying adept and nimble and reacting and getting into each trend while it's still early. So now they're obviously experimenting with RTDs. So if they get that right, it'll work. But that's been my problem with that thing every time I've looked at it. But 3 things I think stood out as interesting. One is, Phil, you mentioned this idea of like looking farther in duration. And when I think about duration, the average person's doing a 5-year DCF, if they're doing a DCF at all, and then saying effectively this business is going to be mature and growing at a rate of GDP. But if you could push out that time frame, that's a lot of incremental value that an investor who's able to kind of look and think that way could actually do quite well. So I think the math is quite simple on that. You just have to be able to say quite assuredly that, well, it might be worth this if it's only 5 years of true growth, but if it lasts longer, then it's worth something more, and try to quantify that. Number 2, I think it's also important to think about how, while we're talking about really big ideas, there are big ideas within big ideas. And I think one of my favorite examples of that, we've talked about leisure. One specific subset of leisure that I'm fascinated by is outdoor participation. And the outdoor participation rate in like outdoor leisure activities, so we're talking about like hiking, fishing, biking, etc., has gone from the low 30% to the mid 50% over the last 15 years. That's massive. And, population is growing behind that. So just think about how many more people are participating in the outdoors. That's a really big trend, right? And yet that's within what I'd say is a subset of leisure. So they're like fractals to this all. You could go really big or you could go just pretty big. And then a third, I'd be remiss, John mentioned Twitter, and obviously everyone knows where I stand. But let me tie Twitter into like one really big trend I am 100% a believer in, which is creative empowerment. I think, historically, whether you look at the music industry, whether you look at, just what it means to be a journalist, where, in The Economist, maybe not wasn't where you're not even allowed to have your name as your byline on certain elite publications. Whatever it may be, if you are someone who is skilled, talented, or just, blessed with beauty or whatever it may be, and you have the ability to reach your fans directly on the internet, that fundamentally changes the opportunity, the idea of an individual as a brand, and creates businesses that had never been theoretically possible before. So I'm fascinated by creative empowerment, and I think it's very real. And I'd say we're probably just in the first inning of that. So those are my three extras that have been coming to mind as we're going through this.
Yeah, those are really good ones. I like all of those.
Great. Well, this has been a terrific discussion. Elliot, I have to apologize to you because you asked me about labor shortages in Europe, and I just went on my rant instead of actually answering
All good. It was
your
great.
question. But maybe we'll tackle that another time. Thank you so much to both of you and to everyone listening. It was a great discussion, and I look forward to next week. Take care for now.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.